Hello, everyone, and welcome to another episode of Millennial Economics. Today, we are going to talk a lot of it about the S&P 500. So let's get started. All right, so I'm super excited to talk with you all today about the S&P 500. It is a great index, a great group of companies to monitor for our future investments or our current investments. This index is going to be a great resource for us to lean on and to invest in to achieve our financial goals and to build our wealth. So there are a few things that I want to address when it comes to the S&P 500 to make sure that you are as well educated about it as possible. This will be a one-stop shop for you to leave this short video with a thorough understanding of what it is, why it's important, and what you can expect from it. So let's get right into it. The first thing that I really want to talk about is, when was the S&P 500 created? Okay, so in 1923, the S&P 500 was actually established. At the beginning, at its inception, it was only following 90 companies. In its current state, which was established in 1926, it started following the 500 companies as it is in its current form, okay? These companies can change, but they typically stay relatively the same over time, all right? So when you take a look at the S&P 500, we're looking at a group of 500 companies, and the reason why we really like it, the reason why it's a helpful index for us is because it has a long track record, almost of 100 years. So it's valuable for us to look at this because we can look at historical data, we can look at historical returns, we can see how this index has behaved, and we can predict, again, with a little bit of caution because you can never tell the future, but we can predict what this index is going to do in the future and how that's going to affect our investments that we have made into it. All right, so the next thing we need to talk about is, what is it? What is the S&P 500? Well, the S&P 500 is the 500 largest or most important, I guess we could say, U.S.-based publicly traded companies. All right, so it takes a look at the 500 largest, most influential companies in the U.S., and that makes up this group, this index of companies that we call the S&P 500. And kind of segueing right into that, what are some companies that are in the S&P 500? You're probably asking yourself. Well, Apple, Microsoft, Amazon, Johnson & Johnson, and Costco are some of these companies that make up this index. Again, there are 500, there are many, many more, and it's a mix of all different types of companies. So you might have some that are technology companies, some that are retail companies. There are tons of different types of companies that build this up, but suffice to say, it's the 500 largest U.S.-based publicly traded companies. The S&P 500 follows. The next thing that we want to ask ourselves is, why is the S&P 500 important to us? All right, so we understand what it is generally. We understand it has a long track record, and it's valuable for us to look back at historical data to try to predict how those companies and this index is going to perform moving forward. But why does it necessarily matter to us? Well, with the rise in popularity over the past few years of index funds and ETFs, there are these groups that you can purchase, or these funds that you can purchase, large groups of companies that follow certain indexes or industries, okay? The most popular, I would say, are the funds indexes that follow the S&P 500. So there are ETFs and index funds like SPY, SPY. I would encourage you to do some research on that. SPDR, SPDR, and VOO, VOO. And essentially, instead of going out and buying individually all of these different companies, all these 500 different companies, which would take you a lot of time to do and probably take you a lot of money unless you're able to use something called fractional shares or buy small portions of those stocks, we can go out and we can buy in one lump sum these funds that mimic the S&P 500 that have small portions. We would have a small stake in all of these different companies, okay? This is a great way to build wealth when we are investing. There are a couple reasons why. Number one, they're well diversified, okay? So instead of owning 5 of these companies, you're gonna own all of these companies, and the market, the S&P 500, typically doesn't fluctuate much day to day, or sometimes even year over year. Now, we do see fluctuations. This index does not increase every year, okay? There are years where it has been down. There are years where it has been up. However, because we're so well diversified, if one of these companies underperforms in this fund, it doesn't totally wreck our portfolio, right? Because we have all of these 499 other companies that we have investments in that we're relying on to perform well. Okay, so it's well diversified. It lowers our risk. It lowers our investment risk because we're investing in many companies instead of just a few. So you might be asking yourself, what's the average return of the S&P 500? All right. Well, since its inception, the average return of the S&P 500 is 10.5% year over year. Okay. So what does that mean? Well, it means that when you invest your money year over year, typically you can expect a 10.5% return. Now, personally, I think that's pretty aggressive. And when I'm running models for what I would expect my investments to be doing, I err on the side of a little bit lower than that, because as we know, we're taking a look at almost 100 years. Okay, inside of those 100 years, there might be a couple years where the S&P 500 is up 20%. There might be a couple years where it's down 30%, right? Or maybe up 5% one year, down 5% one year, up 15% one year, down 2% one year, right? So because we're taking a large look, we are able to see, we're taking a very big picture, right? And it is 10.5%. However, I just want to remind you all that there is fluctuations in the market. When you're investing in 500 companies, those fluctuations typically aren't drastic, but they can be. You know, we take a look at what happened in 2008 with the housing market and the housing crash. And everything that happened with there, the market went down dramatically. The S&P 500 went down dramatically. But for those people that continued to invest and continued to hold their investment, they eventually saw a positive return. But you're not taking a look at 3 months or a year. You're taking a look in those instances at maybe 5 years or 2 years or 10 years. Okay. So that's really a deep dive into the S&P 500. I would encourage you to continue to do your own research and see if this would be a great vehicle for you to invest in, you know, to select some of these index funds or ETFs and to, you know, model out what a 7 or 8 or 10% return would look like over the course of 5, 10, 15 years. You know, maybe you select these funds, as I do, to be the main way that you invest for your retirement in 30 years, right? And again, the great thing about the S&P 500 is it's well diversified, and we have a long history. We have a long track record to look at to see how we think this index is going to perform. So I hope you found this video valuable. I know it wasn't a long one. Thank you so much. And a couple things that I want to mention too. If you liked this video, I would encourage you to like it down below. If you like the content that we're putting out here at Millennial Economics, I would really appreciate it if you subscribe to the channel as well. But other than that, thank you so much for tuning in, and we will talk to you very soon.